This is Metropole Television, most certainly business. My name is Simba Elijah Charles Kiage. Thank you very much for taking your time to join us this morning. This is your economic review. Let's talk about exactly what we have for you this morning. Now, AIB Access Africa data now indicates that for when investors turned into net selling positions in the month of October, with the banking stocks and Safaricom among the most affected. Now, the data indicates that for when investors in October withdrew 1.13 billion on increased risk due to a surge in the COVID-19 infections and deaths that changed the landscape from the two sustained months of net buying, which stood as a huge contrast from August and September, where net buying of 10 million shillings and 802 million shillings was recorded. AIB Access Africa head of research Sarah Wanga linked the October net selling to the increased risk aversion and the reduced attractiveness of the equities as COVID-19 ABIS continues to batter the fundamentals of many companies. This morning, to help us put context into whatever it is that we're talking about, we do have Joanne Maniki and Sadeth Shah. All right, let's begin with you, Joanne, this morning. Is this a case of when investors generally staying away from emerging and frontier markets during the COVID-19 pandemic? If we have to talk about the likes of Safaricom, which are the biggest beneficiaries of COVID, also getting affected?
Thank you very much for the question. I think first and foremost, we need to understand that Kenya is a new and emerging frontier market.
Yes.
And of course, investors would shy away from coming into a market, especially during a season like this, during the pandemic season. So I think their fears are somehow justified because this is a pandemic season and they would rather.
Yes, we seem to have lost that connection to Joanne this morning. As we try and fix it, let's cross over to Shah as well, who's going to also help us weigh in on this question this morning, because this is exactly us from AIB Access who was saying the look that most investors, and I'm talking about foreign investors, they got into the net selling position, meaning that they were actually running away from the local market. And they're saying that we have actually withdrawn 1.13 billion on increased risk due to a surge in the COVID-19 infections and deaths. And they're saying that some of the biggest companies are actually getting affected. Yes, Joanne, are we back?
Awesome.
Yes, we are back. So we could actually continue. Yes, you were saying that we have to understand that Kenya is an emerging and frontier market.
Yes, and therefore investors, of course, in a pandemic would be shy to invest in a market that is emerging. They would be safer and comfortable to invest in a market that they are comfortable and know very well, as opposed to investing in a new market.
Yes. All right, Joanne, just before I let you go on that as well, but how unique is that? Because, I mean, even when you're talking about a company like Safaricom that drives the trading on our books getting affected, what is it saying? Is this just a unique month in October, or generally saying that, well, investors are actually running away from our books? Because, well, if you look at the strongest quarters on our books, it is the banking quarters and Safaricom. So when they're getting affected, should we question that further, that maybe there's something that we should read into that data as opposed to saying they're just quitting?
I think investors generally, when they're doing the investment, they look at a market as a whole and then begin to look at different specific portfolios that they want to invest in once they've decided to invest in a certain market.
Yes.
So I don't believe it's an issue in itself. I believe it's a whole basket that they look at, and then they decide, let's pick certain blue chip companies that are doing well in that particular market.
Yes.
So I would not look at Safaricom as a problem in itself.
All right, Shah, let me bring you in on this as well. We're talking about 1.13 billion that was actually worth off our Kenyan books in terms of wealth from foreign investors. What do you read into that? Do you share the same sentiment with Joanne this morning?
Thank you, Simba. Thank you for hosting us. I indeed do share the same sentiments as Joanne.
Yes.
Based on a couple of factors. I mean, there seems to be a trend where investors are doubling down on what they seek to perceive as a return to fundamentals.
Yes.
To large, more stable markets with more predictable political and regulatory structures and schemes. What this does is it drives investor confidence way more forward. I mean, the virus will remain a threat in emerging markets from where I sit and what I understand. We have even governance, our health systems are weaker than developed nations. We have dense urban slums and high rates of poverty, which multiply the challenges of fighting the pandemic and investment in emerging markets during the pandemic. To just touch on the issue of Safaricom,
yes.
I mean, a lot of measures governments have taken, like the Kenyan government, whereby they've imposed restrictions to curb the spread of the COVID-19 pandemic and implemented measures to try and streamline business, such as free transfer of M-Pesa transactions below 1,000 shillings, which does have a major impact on the revenue streams of such companies. I mean, EABL has been drastically impacted by the closure of bars and restaurants, which all contributes, to a reduction in their stock prices and eventually, shy away from such investments.
Yeah, Shah, the question that somebody's going to ask you really is that when you look at the international environment right now, I mean, somebody's going to tell you, well, the sentiment has been affected across the board because of the coronavirus pandemic. And you like to think that the banking quotas in the country, especially the likes of KCB, the likes of Equity, would give you a proper place to put your money in, and Safaricom. So where are they going? Is there a safe haven right now when it comes to the international investment?
Sorry, Sim.
Yes, Shah, I was asking, I asked you on exactly, well, it looks as if the perfect place to put your money right now in the country could be in the banking quarters. The likes of Equity, the likes of KCB, that have proved that they're actually doing better now. As we talk about the shares not really hitting the 50 shillings mark. So somebody would ask you, where are they heading to then? Yes, we seem to have that technical difficulty again this morning when it comes to managing our online comment. Shah, can you get me now?
Yeah.
Yes.
So I was saying, I mean, banks have taken a major hit during this COVID-19 pandemic.
Yes.
We've seen a lot of loan restructurings. We've seen, in fact, to my knowledge, it's been one of the highest level of loan defaulters we've seen in a long time. So, I mean, all this eventually, if you look at it from a very, how can I say, if we look at this from a wider lens,
yes,
we tend to see a lot of drop in revenues, and I mean, when you see a drop in revenues, eventually the stock price of any company is going to be affected significantly.
Yes.
So in as much as these sectors, the banking sector, the telecom sector, in as much as these sectors are really improving and are more resilient to the pandemic, we are seeing instances where, such companies are being affected, and in as much as it would be a better option to invest in such companies, I mean, there is still going to be some time until we see the stock prices actually, get back to levels they were before the COVID-19 pandemic hit us.
All right, let me just bring you, Joanna, in this as well as we clear this conversation. What does it say about our market now under the COVID-19 pandemic, if indeed stronger quarters like Safaricom and KCB and Equities are the most affected when it comes to international investor flight?
Okay, I think that Like we mentioned before, our market is emerging,
Yes.
and uh, things shares like Safaricom and the banking sector and the construction and EABL are the key drivers of the financial market. So if the entire financial if these key drivers are affected, that means that our whole market faces a challenge. I think that. I would say that our market is 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 facing a challenge.
Yes.
It is it's facing a challenge, but as the pandemic comes down and things look like they'll get to a stable position, then we will need to review maybe in the future how to approach that kind of issues.
Pretty much. Let's just cross over to the next issue this morning. But the United Nations has questioned Kenya's reluctance to take up debt relief initiative by a group of world's 20 major economies, or the G20, amid Kenya's continued struggle to service its debt. United Nations Conference on Trade and Development Secretary General Mahisa Kitui stated the importance the G20 could have had on Nairobi to free up about $900 million, that is about 97.98 billion, in deferral bilateral debt servicing costs, as reports about Kenya being in the market for another COVID-19 loan emerged late last week. Now, the G20 in April agreed to suspend payment obligations on bilateral debt owed by their least developed counterparts through the end of the year, under pressure from global organizations such as the Geneva-based UNICTAD. Now, Makisa noted, and I quote, "Unfortunately, the Kenyan government voluntarily declined to use the possibility of the $900 million on the DSSI when economies which are in a much healthier and stronger position than Kenya are running at that," end quote. He further noted with concern that Kenya's fear that taking the offer could limit its access to international capital markets, could hinder its ability to repay its debts in the year, have not in any way helped slow Kenya's deteriorating credit rating in the international markets. It ends there. Let's have a look at exactly where we are in terms of our external debt. And we're going to look at it from January all the way to the start of the new financial year. And if you look at that data, they're going to say that, well, it has been on an upward trajectory all the way from 2015 up to where we are in 2020. Fine. So let's look at our public debt as well, which is also going to show you the same scenario on exactly where we are. And if you look at quarter one of 2015 up to quarter one of 2020, then you'll actually see that we've been rising in terms of our debt quarter after quarter. All right, let me bring you in, Shah, on that as well. And the first question is going to be, we've crossed the 7 trillion shillings mark, and it's projected that we might get to 7.5 trillion come June next year. How bad did we need this debt relief?
Thanks, Simba. In fact, I've read somewhere that by 2023 we might be surpassing the 9 trillion shilling mark. So,
yes.
I mean, these are worrying signs. The issue that I have with the level of debt that Kenya is actually getting to is a lot of this debt is being used to finance recurrent expenditure and to refinance debt itself. So, I mean, it's quite risky when we are paying more than what we are actually making.
Yes.
And when there's an initiative like the debt servicing initiative by the world G20 countries, I mean, we should be taking advantage of such initiatives. It would allow us it would give us room for fiscal flexibility during this time and allow us to cushion ourselves as the Kenyan economy against, a lot of shocks and impacts that we're seeing in the economy during this time. Why the government has declined to take it, I mean, I've read comments about saying that the deal terms are too restrictive, and I'll have to be honest, I've actually not had a chance to really read into what the DSSI is all about.
Yes.
But saying that it is completely too restrictive and it's going to it is going to have an impact on Kenya's sovereign credit rating, and that may have an impact, in turn, have an impact on Kenya's ability to get future finance later in the year or possibly in 2021. It shows an alarming trend to me, because we need to figure out a way to increase our revenues without relying too much on debt. While debt is good, it is only good, in my view, if it is being used to finance development instead of financing recurrent expenditure. If I'm not wrong, more than 51% of our current budget goes to financing recurrent expenditure, and when you do that, you can't really generate any revenue from this. So, I mean, as a country, we really should have, in my opinion at least, we really should have taken advantage of this debt relief, because it would give us fiscal cushion, enough fiscal cushion to at least try and turn around things for our economy generally.
All right, John, let me bring you in as well on that. And I'm going to take you on exactly what Muhisa Kitui noted. He said that he doesn't understand Kenya's fear that taking the offer could limit its access to international capital markets, and that it could hinder its ability to repay its debts in the near, and that this could have not in any way helped Kenya's deteriorating credit rating in the international markets. Now, that is Muhisa Kitui. Let me take you back to Ukur Yatani. Ukur Yatani says that we have never defaulted on our loan repayments, and it doesn't see a possibility of us defaulting that loan repayment. But Joan, is it possible that Ukur Yatani didn't take this DSSI because he knew very much that it was going to limit him on exactly how much he can borrow while repaying it? Is that not us essentially defaulting?
Wow, that's a dicey question. For me, I think that Yatani looked at it in a perspective that going forward, that that could actually hinder his ability to borrow in the future.
Yes.
And the government is the biggest spender.
Yes.
And the biggest driver of the economy.
Yes.
So when we don't have development of infrastructure or government spending in the economy, that means that the rest of the economy is at a standstill, basically. And we're able to see things happen in the economy because the government is actually spending on development, infrastructure, construction. So it's able to put the money into the system. So I would, looking at it from his perspective, understand why looking forward, he doesn't want to get into a situation where he's not able to borrow in the future. But on the other hand, looking on the short term, in terms of the pandemic and being able just to defer payment and put back the money into local businesses and push forward the SMEs and the small Juakali industry to be able to also finance the small and micro economies.
Yes.
To push production and income of the Mwananchi up. So it's a 50-50 for me in terms of which way forward he would have taken. I think he had looked at it from all perspectives.
All right, Sean, let me bring you in as well, so that now we weigh on exactly where we are. Fine, there were reports that we are actually back in the market again for COVID-19 loan. We have taken more. We seem to be going back for more as well. Sean, yes, we have had a lot of adjustments from the government and also from the Treasury Office in terms of really trying to cushion the economy from the effects of the COVID-19 pandemic. Do you think now, more than ever, that the COVID-19 pandemic has put us in a state where even us, when we are hitting the Treasury Office left, right, and center on where they're borrowing more, that they have to go back and borrow?
Sorry, Simba, could you just repeat the last part of your question?
Yes. So, Shah, I'm saying that are we hitting the Treasury so much in their borrowing trend just because of the hole that the COVID-19 pandemic has put us in?
I would think that we aren't. I mean, it is to a point where, I mean, this whole issue of constantly borrowing is alarming.
Yes.
At least to an extent where, I mean, if we look at the fact that, are we going to, just to take us back a bit, Ukur Yatani's statement that Kenya has never in its history defaulted on any loan repayment.
Yes.
But as we grow closer to this whole balloon of 7 trillion debt, and our domestic revenues have been falling against, a high debt repayment level and subdued economic growth. If you look at it from an economic perspective and just basic economy, it will get to a point where, it's going to be difficult for us to meet our debt obligations. And the worry is that we always seem to be going back into the market to refinance this debt. And when we constantly refinance debt, I mean, it brings in a whole more worrisome picture, because we always seem to be going out there into the more developed countries or the World Bank or the IMF to seek more loans and put ourselves into what I would call a bigger hole, which wouldn't, at least in my view, it's not going to help the economy too much. If anything, it's going to take a longer time to recover out of what the impacts of the COVID-19 pandemic is. I mean, what is more worrying is the growth rate of the debt. If the economy contracts while the country's debt load increases by 15%,
yes,
then I think that is clearly unsustainable.
Pretty much. Joanne, clear for us the conversation, 30 seconds if you may. I mean, what is the alternative now? Because if we're talking about that debt going all the way to 7.5 T next year, June, we seem to, we would have broken the bank. What could be the alternative?
Well, that's an interesting question. For me, I would look at the government looking for short-term ways to repay back what they have already began to borrow.
Yes.
In terms of the infrastructure that's already in place, that what they're putting in place and what they have already done, to see that they can plow back those resources back into the system,
yes,
and pay back part of the debt that they've been able to borrow. So for me, is to see that, to maybe advise that they should quickly try and bring back the money in a short term look, and try and bring back the financing back into the system to be able to repay back the debt that they have already incurred, so that we don't get to the mark of the debt limit. Yeah.
Pretty much. Joanne and Shah, thank you very much for joining us this morning for this conversation on Economic Review. You've been quite invaluable. Let's take a break. Once we come back, Sector Trends.